Hello, everyone. Welcome to our SBR Topic Explainer video. My name is Trevor. Today, we're going to be looking at operating segments. This is one of the shortest standards that we have in our syllabus, and it's covered under the chapter Analysis and Interpretation of Financial Statements. In our session today, I want us to look at 4 key things. The first thing that I want us to talk about is, why is there a need for segment information? Why is it important that companies disclose segment information? And along with that, we need to discuss which companies must disclose segment information. Not every company has to disclose segment information. So we need to have an understanding of which companies must disclose segment information. And the second thing that I want us to look at is, what is an operating segment? And we're going to draw from IFRS 8. It's our standard that governs operating segments. What is it that we call an operating segment? What are the characteristics of an operating segment? Number 3, we're going to look at identifying a reportable segment. Not all operating segments are going to be separately reported on. Some of the operating segments are going to be grouped together, and we're going to call them other operating segments. Some of the operating segments, we're going to disclose them or report on them separately. Segment A, Segment B, Segment C. What constitutes then a reportable segment? How do we make the determination that this segment, we need to report on it separately? These ones, we need to group them together and call them other segments. And lastly, I'm going to briefly discuss the disclosures of segment information. Majority of our time, we're going to spend it on identifying operating segments and identifying the reportable segments. What I've done is, to kickstart, I want us to look at an example, just to have a picture of what is an operating segment. And to do that, I'm going to use a company that we're all familiar with, just for us to have a picture of what could be, what is potentially an operating segment. So let's jump straight into that. On our slide, we have the segments for Apple Inc. We have the Americas, Greater China, Japan, Europe, Middle East, and Africa, which is commonly referred to as EMEA. So commonly referred to with the acronym EMEA. And we also have rest of Asia Pacific. If we look at these segments, I'm sure you can conclude that these are based on geographical regions. So this is an example of geographical segmentation, which is one of the common segmentation that we have with most companies. But this is not the only type of segmentation. But I thought this would just give us a picture of what could possibly be an operating segment. So if you have a company that operates in different regions, and you can have those regions as different segments, different economic risks, different ways probably of operating, different products, different customers. Could be a whole lot of things, but you can group them into those regions. Then the next thing that we need to look at is, why segment reporting? Why is it important that companies disclose segment information? Most of the things here, I'm sure, are just common sense. But I want us to quickly talk about just 3 of these. So the first one is enhanced transparency. When a company discloses segment information, when it reports on their segments, it's going to provide detailed information about different parts of a company, which otherwise do not be aware of. Imagine if you just had one number for profit, one number for assets, one number for revenue. you would not have a good understanding of how each individual segment is operating. So segment reporting then gives you that transparency. So you are given more information. So it provides detailed information about different parts of the company, giving stakeholders a clearer view of the revenue, profits, and risks that come with the different segments. Then this transparency is not only going to help management, it's also going to help investors. It helps analysts. It helps other stakeholders have a good understanding of the company's performance for those different segments. The number three, better decision making. When this information is broken down, when you break down this financial information by segment, management uses already this information to make decisions. Now, what's happening is we're drawing from the same information and we are providing it to other external stakeholders. Now, they can use this information to also make informed decisions. Segment reporting is not going to result in undue cost and burden to the company in terms of reporting. This information is already available. It's information that is being used internally to make decisions. This information is now just being provided to external stakeholders. And performance evaluation, I'm sure this one is straightforward. Because already I've mentioned that this information is available. This information is already being used by managers. Performance evaluation. Now we are just taking this information and we are providing it to other external stakeholders. With performance evaluation, we're saying segment reporting allows for better assessment of performance of different parts of the business. Investors and management are able now to evaluate how each segment contributes overall to the company. Now, this is going to be important for monitoring as well as strategic planning. And we have resource allocation. Now, with resource allocation, because already we've mentioned that this information is available internally. This is the information that is used to allocate resources. So if you have 5 different segments based on geographical regions, now when you do your analysis, when you perform your evaluation, then you're going to go on to resource allocation. You provide resources to those segments that are doing better. This information, what's just happening, we're translating it to external stakeholders, external reports, or we're providing it to external stakeholders. Then lastly, risk assessment. Different segments are likely going to carry different risks. So think about different regions, geographical regions. It's highly likely that these regions will carry different risks. But when you're coming up with your segments, so you're grouping them based on the regions, you'd also want to group them into regions that have similar risks. Because there's different segments, when they carry different levels of risk, then the segment reporting is going to help you understand the risk more accurately. And this is going to result in better risk management strategies. So that's why we need this segment reporting. And the next thing that we need to ask ourselves is, now who has to use, who must use, who uses IFRS 8? Now, IFRS 8 applies to companies that are listed on the stock exchange, or companies that are listed on the debt markets. So these are companies that have debt or equity instruments that are publicly traded. So they're raising finance from the public. So they have to provide more information. They cannot just provide just one figure for profit, one figure for revenue, one figure for assets. They need to break this down. Why? For enhanced transparency, better decision-making, performance evaluation, better resource allocation, and also for risk assessment. IFRS 8 also applies to the consolidated financial statements of a group whose parent is required to apply IFRS 8. Now, this just means that if the parent is listed, if the parent has any debt or equity instrument that are publicly traded, and now it's producing consolidated financial statement, then they also need to apply IFRS 8. And what is an operating segment? We're going to look at it from 3 different perspectives. So an operating segment is a component of an entity that engages in business activities from which it may earn revenue and incur expenses. Keyword is may. So we're not saying an operating segment is a component of a business that generates revenue and incurs expenses. We're saying it may earn revenues and incur expenses. In most cases, it's going to be a component of an entity that actually generates revenues and incurs expenses. But here, this may, we're putting it here because in some cases, you might have a startup as an operating segment, but it's not yet generating revenue. I'm sure you can think of startups that went 2 years, 3 years without generating any revenue. If it's part of the company and it's treated as an operating segment, then it feeds perfectly here because it may earn revenues and incur expense. As much as it's not generating revenues as yet, then it will still fit into this definition. And it's also a component of an entity whose operating results are regularly reviewed by the entity's chief operating decision maker to make decisions about resources to be allocated to the segment and assess its performance. We've already talked about why segment information is important. So 2 of those things we said it's resource allocation and performance review, performance appraisal, performance evaluation. Now, we are saying now an operating segment is a component of a business whose operating results, they are regularly reviewed by the chief operating decision maker to make decisions about allocating resources and performance evaluation. Chief operating decision maker is not a position in the company. It's not a title in the company. It's a function. And I'll talk about that just now. Then lastly, an operating segment is a component of an entity for which discrete financial information is available, which means for which separate financial information is available. So that's an operating segment. Now, what is it that we're talking about? What is it that we're referring to as the chief operating decision maker? Now, this is not a position in the company. This is not a title in the company. So this is a function. This can be an individual or group within the organization that is responsible for allocating resources and responsible for performance evaluation. We already talked about why segment information is important. We said it's for resource allocation. It's also for performance evaluation. And we say that this information, this data points, are already available internally in the company. So in our management accounts, internally in the company, this information is available and it's being used to allocate resources, being used for performance evaluation. Now, whoever uses that information, that's the chief operating decision maker. So this chief operating decision maker could be the CEO, it could be the CFO. It's important that we understand that this is a function, it's not a title in the company. Then the next thing that we're going to look at is aggregation of operating segments. Operating segments can actually be grouped together, but there are conditions for us to group them together. If we're going to group them together, they need to have similar economic characteristics and are similar in the following respects. Either they're producing the same products or providing the same services, they have the same production process, or they have the same classes of customers, they have the same distribution methods. This is going to be key when it comes to reportable segments. You can actually aggregate, you can bring together 2 or more operating segments that have similar economic risk. Then you present it or you report on it as one segment. Another practical example here, it's the Coca-Cola company. With the Coca-Cola company, I'm sure you're noticing some similarities with Apple company. They have geographical segmentation, Latin America, North America, and they've Europe, Middle East, and Africa. Remember that acronym, EMEA. That's what we have again here. This is a geographical segmentation. But the Coca-Cola company also has non-geographical segmentation. They have the bottling investment. They also have the global ventures. This has nothing to do with geography. These are non-geographical segments. The reason why we have this slide here is to understand that segmentation is not always about geography. Yes, in most cases, companies segment by geography, but it's not just about geography. There are also non-geographical segmentations. That's what we have here on the slide. The next, we're going to look at reportable segments. So we have understood what an operating segment is. We say it's a component of an entity that engages in business activities from which it may earn revenues and incur expenses. We also say it needs to have discrete financial information, needs to have separate financial information. And we say this is a component of a business whose operating results are regularly reviewed by that function. Remember that function? The chief operating decision maker. And they need to review this financial statements or financial information to make decisions about resource allocation and performance evaluation. Now, the question is, when does the operating segment become a reportable segment? So one, if its reported revenue is 10% or more of the combined revenue of all operating segments. Now, this is very important. But we are not just talking about external revenue. We're not talking about segments selling to external customers. We're talking about combined revenue. So if the reported revenue is 10% or more of the combined revenue of all the operating segments, then it's a reportable segment. So that's both internal and external. So when you are looking at a question, before you use this threshold, first add internal and external revenue, then you apply the threshold because it's combined revenue. Then the second one says its reported profit or loss is 10% or more of the greater in absolute terms of the profits. Assuming you only take segments that generated a profit, or losses, that's combined losses, assuming you only take segments that incurred losses. Now, this one is a bit tricky, so we have to stop and think about what we're saying here. So we're saying it's going to be a reportable segment if its profit or loss is 10% or more of the greater of the two. Now, what this means is you need to look at all the profit-making segments, you add their profit together. Then you look at the loss-making segments, you add the losses together. And you do this in absolute terms, meaning you're not considering any negative values or positive values in absolute terms. So you just take the numbers. Forget about the negative and the losses, just add the losses together, add the profits together. Then you choose the greater of the two. Once you have the greater of the two, then now you'll be looking at your profit or your loss. You say, is it 10% or more of the absolute amount? And this will become clearer when we look at an example. Then lastly, its assets are 10% or more of the combined assets of all the operating segments. And this one is straightforward. The first one and third one are straightforward. The second one is the one that's a bit tricky, but it will be clear when we use an example. There is a secondary criteria though. The secondary criteria says, when you have these reportable segments, when you have identified them, at least 75% of the entity's external revenue must be included in the reportable segment. Now, this one changes the game. Now, it's saying you have identified these reportable segments. Now, when you add them together, at least 75% of the entity's external, keyword external revenue, external, should be included in these reportable segments. On our reportable segment here, we talked about combined revenue. What we have here, these are the primary criteria. Now, once we have gone through the primary criteria, there is the secondary criteria, which is that 75% of external revenue. We're going to illustrate this again with the example. IFRS 8 is the only standard that has a materiality threshold. You actually have an amount. We're told that it's 10%. Every other standard, when they talk about materiality, they do not give you a percentage. So IFRS 8 is unique. There is that rule, a 10% rule that we have to always remember. 10% of assets, 10% of combined revenue, internal and external. Then when it comes to the profit, we say that one is a bit tricky. So we're going to work through that, use an example for it to become clear. But this is the example that I want us to work through. So we have a company that has 5 operating segments. So that the groceries, clothing, shoes, DIY, electricals. Then we're given the external revenue, internal, division profit, division assets. We're also given liability. Did we talk about liabilities? No, we did not. So liabilities, we are going to ignore them. We are only going to focus on combined revenue, on the absolute amount of profits or losses, then the division assets. And I'm going to do this calculation on Excel. So we quickly just go through that. So we're going to put our threshold. Yeah, we know it's a 10%. The criteria that we talked about, the first one for reportable segment, we said it has to be 10% or more of the combined revenue. What am I going to do here? So we need to have combined revenue. It's important. We need to have combined revenue. So we add in external plus internal revenue. And once we have that, then we add it together. Our combined revenue is 452,000. It's our combined revenue. And we said our criteria say it has to be 10% or more of the combined revenue. If the threshold is 10%, I mean, we say 10% of this. So that's 45,200. That's our threshold. Now let's go to our operating segments. But we say that it has to be combined revenue. This combined revenue has to be 10% or more of the total. But you look at groceries, it's 160. So that meets the criteria. This is 132. It meets the criteria for revenue. 44, does it meet the criteria? No, it doesn't. 30 doesn't. 84 meets the criteria. So the groceries, clothing, and electricals would meet the criteria for revenue. Now let's look at the second one, which was the profit. So we need to remove these losses. Let's put them separately here. Because on this criteria, we need to look at profits and losses separately. So this would be the losses. But not only that, we need to consider only absolute amount. So let's forget about the loss being a negative. So we just use this as a 4. This would be 2,000. Then we add together. So there's a 50, then there's a 6. So the profits equal to 50, the losses equal to 6. Remember, forget about the negative. Don't think about the losses as -4, -2. The criteria says absolute amount. So we forgetting about the negatives. So we need to take the greater of the two. 50 or 6, which one is greater? Obviously 50 is what? 50 is greater. Then we apply the threshold. We'll apply the threshold, say 10% of 50. That's 5. And remember, we are only considering absolute amount. Forget about the loss being negative. On this criteria, then it means, again, groceries will meet the criteria. 18 will also meet the criteria. But then the others are not meeting the criteria because they're below 5 as an absolute amount. So we had to take 10% or more of the greater of the two, greater of the combined profit, absolute profit, combined absolute losses. Then lastly, we go to our assets. Our assets are 630. Our threshold would be 10% times 630. That will be 63. So any of these operating segments that has more than 63,000 clothing meets again. Then electricals meet. So we have 3 operating segments here. We have the groceries, clothing, and electricals. You might be asking yourself, why is electrical still an operating segment, even though it didn't meet the profit or loss criteria? It just has to meet one. Then it's a reportable segment. After this, then there is a secondary criteria. The secondary criteria then says, now let's consider only the external revenue. The external revenue should be more than 75% of the external revenue, of the total external revenue. So we take the external revenue is 362. So we're saying groceries, clothing, electricals, these have met the criteria. These are now operating segments. Then let's take their external revenue. So the external revenue is 290.94. We take the 294, we divide with the 362. That's 81%. So it's also meeting the secondary criteria. If the secondary criteria was not met, if the external revenues did not exceed 75%, then we had to go take either the shoes or the do-it-yourself. We take the higher of the two. We need to combine it. We need to bring it, to get to the 75% threshold. That's where the aggregation then would come in. You could either take one of those operating segments, you combine them with an operating segment that has similar characteristics, similar economic characteristics, so that the secondary criteria is met, where the external revenue has to be more than 75%. So I hope you're able to follow this example. If not, stop this video, go back again, try it again. The one that's just tricky is the profit or loss. Remember, with the profit or loss, it has to be absolute amount. So you separate the profits and the losses. Forget about the signs. Add together. You need to take the greater of the two. Then now you take 10% of the greater of the two. And to wrap up our session now, we are looking at disclosures. So there is an example of segment reporting disclosures. The disclosures are going to be a bit detailed, but here I'm just going to give you a summary. That you would have to consider the factors used to identify the segments. Then you also need the information about reportable segments, the revenue, the profit or loss, assets and liabilities, other segment information. And there are obviously going to be reconciliations and also entity-wide disclosures in some of the judgments. Because the standards, there are going to be lots of areas where judgment is going to be used. So you need to disclose that. And as a summary of our session today, so we talked about the importance of segment reporting, importance of segment information. We talked about enhanced transparency, improved decision making, among others. And we talked about what an operating segment is. We looked at the three things that we need to consider. Said it's a component of an entity that may earn revenue and incur expenses. And we also said it's a component of a business whose operating results are regularly reviewed, keyword regularly reviewed, by who? The chief operating decision maker, which is a function. And they want to make decisions about allocating resources and performance appraisal. Then we said it needs to have discrete information, must provide discrete information. Then we went on to talk about reportable segment. When does it become reportable? We looked at the three primary criteria. 10% or more of the combined revenue, combined, not just internal or external, combined, add them together. 10% or more of the assets. With the profit or losses, we said it has to be 10% or more of the greater of. You take the profits only, add them together. You take the losses, add them together. Forget about the losses being negative. Take the absolute amount, then you take the greater of the two. That's the one that you apply that 10% threshold. And there's a secondary criteria. Once you have those reportable segments, you need to consider the external revenue that has to exceed 75%. If not, then you need to aggregate some of these segments. Then lastly, it was the disclosures. So that's it on our operating segments. So I hope you have enjoyed the session and you were able to follow along the session. If there's anything that you did not understand, always go back to the part that we're explaining. Stop the video, rewind, go back to it, and also go to the SBR platform, go through the text itself just to make sure that you have clearly understood everything. That's it for me. Cheers.